So for the first topic on demand supply, basically we want to know what is the difference between change in quantity demanded versus change in demand, right? So change in quantity demanded is caused by price, and it results in a movement along the demand curve. So this is shown by a movement, and we use the term here is quantity demanded. Next, what is change in demand? Now, it's caused by non-price determinants. Non-price determinants include prices of other goods, so prices of substitutes, for example. And these are the list of non-price determinants, which means you are required to know all these non-price determinants, right? So it is important to know all the non-price determinants, and it results in a shift of the demand curve. So this is shown as a shift of the demand curve. Remember always that increase, you will always shift right, decrease, shift left. So one example, alright, same for quantity supplied and change in supply, the idea is the same. So change in quantity supplied is caused by change in the price of the good itself, and is shown as a movement. So change in supply will be caused by non-price determinants, and these are the non-price determinants of supply. So take note that the non-price determinants of demand and supply are different, right? So anytime, at any point in time, there is only one non-price determinant that will happen. So it will affect either the demand curve or the supply curve, which means you have to know all the non-price determinants of demand and all the non-price determinants of supply. So one example on the slide. For example, DVD player, in the market for DVD player, if we assume that DVD is a normal good, then an increase in income can lead to a rise in demand. Therefore, the demand curve shifts to the right. And we make use of demand and supply because we want to find out what is the equilibrium price and quantity in the market. So what is equilibrium? Equilibrium is when quantity demanded equals quantity supplied. So if I draw this, I have equilibrium price and quantity, and any price that is above, there will be a surplus. Price that is below will result in shortage. So surplus and shortages, they are known as disequilibrium positions. How do you identify if a particular question is asking you about demand supply? We can take a look at one of the past year test questions. The clue to answering such questions is when the question asks for what are the effects on the equilibrium price and quantity. So if you see the word equilibrium price and quantity, then this is a clue that you should be drawing a demand supply question. So illustrate and explain the effects on equilibrium price and quantity of kebabs when there is a fall in consumers' income. So in answering this question, since it says illustrate, you will need to draw the diagram. So in all diagrams, make sure you label the axis, the graphs, and you have to put in the equilibrium point. So based on our answer in part A says that in part A actually we concluded that kebabs are actually an inferior good. So when there is a fall in consumers' income, the demand for kebab will increase. In answering demand supply questions, when you explain, first you have to state the determinant. So since kebabs are an inferior good, that is the non-price determinant. And when there is a fall in income, demand will rise. So when demand increases, demand curve will shift to the right, and it will result in a change in equilibrium point. So Q1 to Q2 and P1 to P2. So explain the effects on the equilibrium price and quantity. Demand will rise and equilibrium price will rise. Equilibrium quantity will rise. And these are the points needed for demand supply questions. First, the non-price determinant, demand supply rise or fall, or you can say shift left or right. Then what is the effect on equilibrium price and quantity? Make sure you do not write in point form and don't use short form in your answers. The next topic is on elasticity. for elasticity, under price elasticity, usually you will not be asked definition type of questions, but if it's in a multiple choice, you need to identify correctly what is the definition of price elasticity, demand, supply, and so on. For price elasticity, these are the few things you need to know. First is the formula. So you will need to be able to calculate price elasticity of a particular good. Now, price elasticity always gives a value that is negative because of the law of demand. The price elasticity value is always negative. So we will need to classify. After calculation, you will classify a particular good, and there are 5 classifications, right? So there are 5 classifications of price elasticity of demand. Okay, so this is the formula, and there are 5 classifications. When you classify, you remove the negative sign. Since it is always negative, when we classify, we will start from 0 all the way to infinity. After classifying, you will also need to be able to draw the 5 types of demand curve, meaning perfectly elastic, inelastic, unit elastic, and so on, all the various types of demand curves. You are also required to know the relationship between elasticity, price elasticity or EP, and total revenue. This is applicable to sellers because they would like to increase their total revenue. So if they know that a particular good demand is elastic, they will decrease price. And if they know that a particular good is inelastic in demand, they will increase price in order to increase total revenue. Next is cross elasticity. Now notice that for the other elasticities, it's only the denominator that has changed. So in this case, we are measuring cross elasticity. It is with respect to the change in price of another good, right? For price elasticity, it is with respect to the change in the price of the good itself. So now we are measuring the change with respect to price of another good, and so for cross elasticity, you will need to know the formula, and after calculation, you should be able to classify. There are only 2 classifications: substitutes and complements. In this case, the sign is important. Because positive or negative will determine if the 2 goods are substitutes or complements. Next is income elasticity. So income elasticity measures change in quantity demanded with respect to change in income, percentage change. And again, so for income elasticity, it will be knowing the formula and classification. In the same case, sign is important. And also take note that for positive values, you need to specify if the good is a normal good, is a necessity good, or is it a luxury good. Next topic will be markets in action. So in markets in action, there are two types of price controls: price ceiling and price floor. Now for each of these, you should be able to identify when to use a price floor and when to use a price ceiling. For price ceiling, the objective is to protect consumers or to help consumers, and therefore is to keep prices low. For price floor, the objective is to protect sellers, and you want to keep prices high to ensure a minimum income for the sellers. For both cases, you are required to know how to draw the diagram and then explain what you have drawn. The other concept that we covered under markets in action would be sales tax. So under markets in action, there are these two diagrams on price ceiling and price floor. Under sales tax, there are 4 diagrams on page 4-4, which you are required to know, and another 2 diagrams under tutorial 4 question 4, which means for sales tax, there are altogether 6 tax burden diagrams that you are required to know. Now these first 4 diagrams are extreme cases, meaning only one party bears the tax. For the question in tutorial 4 question 4, these 2 diagrams are cases where demand is elastic and where demand is inelastic. So elastic and inelastic demand curves. They are downward sloping. They are not extreme cases, meaning they are not either vertical or horizontal. So in this case, if demand is elastic, sellers bear more tax. But if demand is inelastic, consumers bear more tax, more of the tax burden. We will use one of the past year test questions, which is on olive. To help us to answer questions on tax burden, so we take a look at question 3A. This is from 14-15 October semester test paper. So question 3A, it says that assume the supply of sports shoes is perfectly elastic. This is an extreme case because of the word perfectly elastic. So perfectly elastic is a horizontal line. So the supply itself is perfectly elastic, and demand is normal downward sloping demand curve. The question says, explain the effects on the equilibrium price and quantity when a tax is imposed. Who bears the burden of the tax? Again, we see the word equilibrium price and quantity. It tells us that we have to draw demand-supply diagram. So when a tax is imposed, we start by saying that tax raises production costs. And so this will lead to supply falling. Because this is a horizontal supply curve, instead of shifting left, it will shift up. If it shifts down, the price will fall. So when a tax is imposed, price should increase. Therefore, it should be shifting up. So we look at the equilibrium point. So this is Q2. Previous point was Q1. And this is P1 and P2. the effects would be the change in equilibrium price. We can see from the diagram that equilibrium price rises, equilibrium quantity falls, as shown by the arrows. The tax burden is illustrated by this rectangle. So we label this as consumers' burden. There is a change in equilibrium price, and consumers are now paying a higher price, whereas for sellers, they still receive the same amount. Therefore, sellers do not bear any burden of tax. And so we say that consumers bear entire tax burden. Therefore, in all the tax questions, you will need to explain about tax raising production costs, how the supply will shift, effect on price and quantity, and then who bears greater burden, or who bears the burden of the tax. Reminder that for this topic, there are 6 tax burden diagrams and price ceiling and price floor diagrams. So all these diagrams are important. One of them will usually be out for both tests and exam. Under this topic, we covered the law of diminishing returns. And this law is only applicable in the short run, meaning whenever there is a fixed factor present. Short run is defined as the time period when there is at least one fixed factor. So the law of diminishing returns is only applicable in the short run. Under this law, you are usually required only to draw MP. Do not worry too much about TP and AP. Just focus on MP. So the law of diminishing returns sets in after maximum MP. And the law states that if you have more and more labor being added to a fixed amount of capital, the marginal product of labor will fall. So you use the diagram to explain or to account for the shape of MP. So that's the first part on output and cost. The other part that we want to focus on would be on the formula. So in the calculation of costs, we separate into fixed and variable costs. And these are the formulas which you are required to remember for fixed costs and variable costs. This is total cost, total fixed cost, and total variable costs. You can move the equation around if it helps you in your calculation. And you need to know the shape in general of all the cost curves. So output and cost, know the formulas. That's the first part. Shapes of the and drawing of cost curves. For example, TFC is horizontal, TVC and TC are all upward sloping. And if you look at the average cost diagram, ABC, ATC are U-shaped, MC is also U-shaped, and AFC slopes downwards. So know all the formulas and how to draw all the different cost curves. In the long run, the curve is much simpler. It's just a U-shaped long run average cost curve. And just know some examples of economies and diseconomies of scale. In this topic, we also covered explicit and implicit costs. Explicit costs are costs which are paid for with money. That means they are the direct costs in the production process. Whereas implicit costs are not paid with money, they are more of foregone opportunity costs. An example of implicit costs usually what we have is foregone salary, foregone interest, and foregone rental. These are the usual implicit costs that we will encounter. And we make use of explicit and implicit costs to do our calculation for accounting and economic profit. So that is for output and costs.